Hello, everyone. Thank you for joining us today. My name is Brian, if you haven't met me before, and I'm really excited to have Ryan Pettitt joining us from Prosperity Aid. He is the project manager, and I want to get started with a few things. We'll be talking today about profiting with private placements and understanding the opportunities that are there for passive income. So just a few things about Newview. We have to admit, we are not CPAs. We're non-fiduciary. We do not provide any tax advice. We are simply the conduit that people would use when they want to make alternative investments. So what we are is we're that access to give people, I'll give you an example. You have Fidelity, Charles Schwab, companies like that hold stocks, bonds, mutual funds. We're on the other end of the spectrum. We can hold alternative assets like real estate, private placements, if you want to join syndications, purchasing land and precious metals, tax liens, things of that nature you can do with a self-directed IRA custodian. So Newview's been in business since 2003, but self-directed IRAs themselves have been around since the 70s. Many people are not informed that they're able to hold alternative assets in their IRA. We've helped about 15,000 clients build their wealth for retirement. There's some great tax incentives by doing that. Your assets can grow for you tax deferred or tax free if you do things the right way, of course. So we can always schedule a one-on-one and we can talk about what your investment ideas are. So feel free to reach out to me with that. We do custody 1.4 billion in client assets. And one of the things we do pride ourselves on is being simple to do business with and responsive and always available for our clients, whether it's an email, you reach out to us on our website, or you call us directly. We strive 99% of the time to, get back in touch with you as soon as possible. So without further ado, I want to introduce you to Mr. Pettitt, correct? And he's going to be taking over, talking to you all about private placements.
All right, thank you, Brian, and welcome to the webinar. We'll be diving in with a good bit of information at a high level, and just know that there are a lot of intricacies that are come into play with private placements and syndication. So definitely an opportunity to get the initial exposure and then continue to have those conversations. So as we dive in, the first thing I want to do is, oh, we lost the screen there, Brian. I'll try to do it on my end. Do you guys have it back up? There we go. All right. So before we get started, very similar to what Brian mentioned, have some disclaimers here. So this is not an offer to sell or a solicitation or offer to buy or recommendation of any security product or service. And the information here should not be utilized as tax, legal, or investment advice. I am not an attorney. I'm not a CPA. So definitely always encourage you to work with your respective team. And then ultimately, everyone should also do their own due diligence when they make any kind of investment advice or investment decision, and ensure that it meets your strategy or philosophy. And then, of course, as it relates to that tax and legal, always work with those professionals to make sure that you determine what works best for you. So diving in, I want to give you a little bit of details about myself and my business partner, Curtis. So collectively, we have over 25 years of real estate experience, and we believe heavily in financial education for investors. And that's part of the reason why we do these types of events with webinars. We also host virtual cash flow games as well, and lots of opportunities to give back and help to promote the growth of investors, and specifically believing in diversification away from the volatile stock market and making sure that there's those tangible assets that can hedge against inflation. With a syndication or private placement company, what we do is that we essentially aggregate investor funds for large projects, being able to pool funds from multiple investors, both accredited and non-accredited, and be able to participate in real estate assets that may not otherwise be able to do so on your own. And specifically with our company, we're looking at those turnkey opportunities from an investor standpoint, where you've got that passive cash flow. We believe in diversification with various assets, and specifically it's managed by our team as well as our reliable partners. And ultimately you see that we believe in passion and also prosperity for our investors. So I want to give some definitions because used a few different terms already and between syndication and private placement. So syndicate is a temporary professional financial service alliance formed for the purpose of handling large transactions that you would not be able to do so individually potentially. And a syndication is essentially allowing those investors to pool their financial and intellectual resources into those bigger projects. It can also be referred to commonly as a private placement, which is also kind of the sale of securities relative to a small number of select investors. And the difference between syndication and private placement is a lot of times syndication can be referred to more at a corporate level. So you think about big funds that exist. And a private placement is kind of that smaller scale where you're working directly with those partners. And it is something that cannot be found on the open internet or any awareness of what you're investing in outside of what your tax and legal professionals know. So let's talk about some of those benefits associated with private placements. So first is growth potential for all parties. So not only the sponsors or the managers of that project, but also the investors. It offers that privacy, as I mentioned, for participating investors. So it's not something that a person could go out and actively find out there on a business website or searching for what you're invested in. There's limited investor participation. So those spots are only open up to a small number of individuals depending on the size of the raise. And specifically, if it's for non-accredited investors, only 35 can participate in any given project. It also offers the opportunity to diversify your portfolio in real estate and multiple real estate assets, and something that you may not have experience with from a market perspective, or even that particular asset, and leveraging that experience of your sponsor. You can build your experience resume and kind of be able to say, hey, I am part owner in a resort property because you're participating in that private placement. It also provides a division of risk between the members. So it spreads that risk so that you're not the sole person at any one given project. And it can be divided amongst yourself as well as the sponsors and other investors. And then you're also leveraging that expertise of the team. And I always like to say, you want to make sure that you're working with folks that you know, like, and trust. Of course, part of the benefit is passive income for the investor and the ability to participate in those projects and achieve those returns. And then there's a speed of execution for funding. So typically projects last a few months. Sometimes they will go upwards of a year, but it's really fast from a closing standpoint. And then also the ability to start making returns on those investments depending on that particular project. There are some tax advantages that could hedge against inflation. Of course, talk to your CPA about those. And then one of the things that we're talking about here on this webinar is the use of a self-directed retirement fund. So you can actually invest in a private placement with your IRA, and making sure that you've got it set up and proper paperwork and working with your custodian there. And then there's ultimately unlimited wealth potential as you think about being able to tap into other markets and other opportunities. So I want to give a high level detail of some types of projects that would be available. So one would be debt financing, and that's where investors are essentially acting as the bank, and they're the creditors against the project. There's also equity raise, and that's where investors have that ownership in that equity. And a lot of times that would be referred to as a reverse syndication, pulling that equity out of those properties and getting a return based on the cash flow. And then there's funds, which are kind of a blanket raise, where it's saying based on the particular market and or the asset in which you want to raise funds for a particular time frame, there's not going to be an identified property up front, but more so the parameters that exist. And within those three buckets, a lot of different opportunities that exist. A few examples including development, buy and hold for long-term cash flow, value add or refinance, and as well as renovation and flip. So as we think about the difference between accredited and non-accredited, for those that you may not be aware, accredited investor is a net worth that exceeds $1 million, and that does not include your primary residence, or it's an individual that exceeds $200,000 per year for the last 2 years, or as a couple, $300,000. When we're working with non-accredited investors for private placements, there are those opportunities depending on how it's structured, which we'll talk about, but essentially wanting to make sure that there's a level of sophistication with that non-accredited investor, understanding the risk, and of course, having some exposure to investments in their portfolio. And want to make sure that in that process, one of the things that is required is that you have to fill out a questionnaire, understanding what your current net worth and income is, for the fact of making sure that you meet that threshold of a sophisticated investor. So paperwork is a big component of a private placement. And this is all the fun stuff that you read at night to put you to sleep. Lots of pages, lots of details and information, all the legal documentation to make sure that the details associated with the private placement are spelled out, and knowing those risks that are associated with it. So first is the executive summary, and that is really the details that are kind of building out the high level information, usually an average about 10 to 15 pages, having the pictures, the graphs, the reason, background, and information about the team. There's also typically a request to sign a confidentiality agreement or non-disclosure agreement. And the reason being is just making sure that that information is held close to vest so that it does not go out there into the open marketplace, keeping the integrity of a private placement. And then there are additional offering documents that are a large packet of information with the private placement memorandum that spells out all the details associated with the risk, as well as how returns will be shared, and making sure that you're aware of that investment. And then there's the operating agreement, and that is essentially the details outlining information about the business. That purchaser questionnaire that we talked about, making sure that you're qualifying yourself as a credited or non-accredited investor, depending on that particular project. And then ultimately the subscription agreement. And that's where you're actually signing and saying, I am participating in this investment and this is my contribution toward it. So as we think about those parties that are involved, some of those details that are included in that paperwork, some terms just for awareness, is that there's a class membership. And there's no direct way in which this is defined. It depends on the project and how it's established, but typically you'll see memberships referred to as A, B, C, etc. And that's your classification and how you're participating in the projects. A lot of times, what we do is we structure and say our investors are Class A members. They're the folks that are getting the return, and it's spelled out that way. There may be different levels depending on the amount of contribution, as well as the specific segment or phase of the project that you're participating in. There's the company or issuer. So that is the syndication company that owns that asset or the houses that are associated with it. And then the manager supervises the raise and the project. And sometimes it's one and the same with the sponsor that oversees the operations and acts as that manager for the syndication company. So just from a visual standpoint, understanding what an entity structure looks like, you'll see that up at the top right, there's the sponsor company. And so for example, Prosperity Aid Capital Group, that is our sponsor company. So when we go out into the marketplace, that is our branding and marketing. Underneath the sponsor company is where that individual syndication LLC exists. And that's where investors are participating as shareholders within the syndication company. And they're essentially purchasing units in order to participate as a limited partner within that LLC. To then, that LLC owns that real estate associated with the project, and that's where the return is generated. And of course, there's management fees that are sent to the sponsorship company as well. So as we think about some of the details associated with passive income, tax advantages, and exit strategy, there's a couple of different things that, to call out just so you understand how profits are split. So there's several different ways in which it could be split with investors. So it could be a straight split, and that is typically a percent mix. A lot of times you'll see on average an 80-20 split where 80% goes to the investor and 20% goes to the manager. Or you might see a 70-30 example. A preferred return, the difference between that is saying that the management company will not receive any of the returns until the project hits a certain threshold for return to the investors. So the investors are hitting that percent first before there's any kind of split. An example would be an 8% preferred return, which means that all profit that is incoming goes directly to the investors up into that point where it's 8%. Then there starts to become a defined split, and then it can continue increasing from there with the split between the investor and the sponsor. Then there's also waterfalls, which are kind of complex in nature, and it just depends on the phase and the return of that particular project. And there's different gates that exist, and essentially as how those returns. One that's not captured on here, or on that percent, is that fixed return on the next line item, and that's essentially saying, hey, you're going to get a consistent return for that cadence and how profit is split. So it won't change. It may be anywhere between a 6 to 12%, and that is going to be your consistent return. Then there's also the hold strategy, where you think about what are your investment philosophies and what kind of return are you seeking. So is it for cash flow? Are you seeking rental income? Or are there other thoughts around some of the tax advantages, whether it's depreciation or deductions? And then ultimately, how are you going to exit? And specifically, these are details that need to be captured within that private placement memorandum and disclosed to those investors. So is it a value add opportunity? Is there appreciation or even a refinance? And are there options for the sponsor and or members to participate if someone else decides to exit, if that's an option? Or is there going to be a sale of the property, or is it a long-term investment at that point? So as we think about the compensation, of course, one of the big questions that we receive is, how are you being compensated as a sponsor? And of course, this is a business, so there has to be some level of compensation. And compensation can be split. As I mentioned, there's a management fee. It could be either a fixed salary, a percentage of that asset value, salary plus bonus or profit sharing, or a hybrid. And typically that management fee is a fixed amount or detailed in that pro forma as far as that upfront cost. And then there's also specific services that may be included in that pro forma, whether it's transactions or how the note is being serviced, or even there's a promote or fundraising amount. Again, all of these details are included in that pro forma. Then there's the profit sharing aspect. So this is after funding has taken place, and essentially that's where I mentioned some of those split options from a investor standpoint. The reverse is true for a sponsor as well. So it either could be a fixed or a straight split, a split after that preferred return, which we talked about, or that waterfall strategy, which creates some additional complexity there. So as we think about different opportunities that exist in private placements, there's a lot of different assets that you could participate in. So here are just some examples. So you could see hotels or resorts, some international properties, agriculture, residential, and both single family and multifamily, commercial or even mixed use buildings, apartments, residential assisted living, and of course, a hot term in the marketplace is opportunity zone over the course of the last year and a half. So these are all different types of projects that exist depending on what the sponsor it has from an investment standpoint. And it opens up the world of opportunity for investors to participate, again, in these different types of assets, leveraging the experience and expertise of that sponsor and knowledge of that marketplace or that particular asset and the team that they have in place, so that you can participate in other things outside of maybe your general radius. So some additional things to take into consideration as you're thinking about participating in a private placement. One thing to notice that investors do have a limited control on the decision making. All of those details are captured within that PPM. And one of the reasons why is of course, you're employing the sponsorship company as a trusted resource for those returns. And that's one of the reasons why, as a participant in a private placement, you're referred to as a limited partner. There's also a potential lack of liquidity based on that project structure. Again, all of those details are captured within that documentation and include information of, hey, what happens if you need to exit, and how do you work with that sponsor to make that decision. We always like to say that, hey, when you're working with us from a private placement standpoint, it is a marriage. You have to make sure that you, again, know, like, and trust your provider, and that you're essentially building that long-term relationship, because that's potential restriction that exists with that liquidity of that asset. And then kind of tied into that is that long-term relationship. As I've mentioned, there is the ability to diversify your portfolio, participating in a wide range of different assets and different markets. And you can specifically gain that experience. As we talked about, that adds to your resume to say, hey, I am part owner in this resort property or this agriculture project. You can also compress timeframes. So, if you were in comparison doing a project actively yourself, where you have to do all of the renovation and the refinance, obviously that's a lot of time on your plate. You're employing the use and experience of that sponsorship company to make sure that you can expedite the timeline in which you can get returns. There's also a limited access to private placement opportunities. What I like to say is that ultimately, private placements are kind of one of the best kept secrets in the real estate world, and it's really about who you know. And the reason why it's kind of so difficult to find these opportunities in some situations is because we talked about the non-accredited versus accredited. If a project is going to have accredited or non-accredited investors involved, that company cannot market that opportunity and has to utilize its existing network of people. So that's why it's kind of sometimes difficult to find those opportunities, unless it's an opportunity that is strictly accredited investors in which that can be marketed. But the best way to combat that is establishing a relationship with a good sponsor that has deal flow, and that also has that abundance mindset where they are able to refer out to other sponsors based on your investment philosophy and what makes sense for your particular portfolio. So always kind of build yourself with a team of people and folks that have your best interests, that have that network that they could tap into to make sure that you're ultimately making the right decision for yourself. It is eligible, as we've talked about, for self-directed retirement accounts. So it is something that is allowed within the IRS that you can participate in and set that up and have those distributions directly into your account. As we talked about, there are risks associated with any type of investment, but the great thing is that these are divided between the members, and there is always the potential for a capital call. So make sure you're having those conversations with the sponsor. Ultimately, the goal for a sponsor is not to have those situations arise and to mitigate that risk, and making sure that everything is planned from a pro forma basis on a conservative nature. In worst case scenario, to make sure that there a lot of time is a pool of funds that are involved in the project that are sitting there in essentially an escrow account that can be tapped into if and when the worst case scenario happens, and you're able to utilize those funds before going to the investors to have that discussion for a capital. So the other thing that I always like to call out is make sure that you conduct your own due diligence, both on the market as well as the company. So evaluate through various resources. If you have the team available to conduct boots on the ground research, do that, or you yourself. But the team that is involved with the syndication company also has done their fair research to make sure that this is a viable option for both yourself and for the investors at large. And then with the due diligence of a syndication company, look for the character and experience of the company. Make sure you find the right fit for you and that right team that can support your investment goals and your philosophy. As I mentioned, know, like, and trust them. Making sure that you understand that that is a long-term relationship, and know that not all opportunities that a syndication company may have may not be right for you. And so that's where having those relationships and ability to refer out to other companies also becomes beneficial. I would encourage you to make sure that you have a common interest, and that they're able to provide the added value, and that, you know, a lot of that is through education and then experience. You can actually do what I like to call a ride along, where you're able to sit in and understand what those details are and how syndications are set up to get that experience within your resume. Make sure that the company has proper paperwork and all of the legal documentation and everything is buttoned up, and have the proper relationships with financial institutions, insurance companies, as well as the legal advisors. So not only do they need just the entity legal portion, but there's also the need to employ a SEC attorney, because again, this is considered a security. So those syndication companies need to have the relationship with a solid SEC advisor. And then ultimately, you could also perform a background check to make sure that there's no issues or concerns. One of the great things from a requirement as we think about SEC is there's what's called a bad actor. And that a syndicator or a manager of that syndication has to confirm that they are not a bad actor, and that there have not been any litigation or lawsuits against them that would cause issues with the syndication and the private placement in those investors. Some other tips, tricks, and best practices to think about is that, as I mentioned, there's risk associated with all investments. There's no guarantee on performance or returns. Always think about your personal investment philosophy and what that means. And we'll talk about here as we're closing out that I would encourage you to have a discussion with someone if you're not exactly sure what your investment philosophy looks like. To make sure that you define that and have those details available. And then ultimately create a diversified portfolio and spread that risk. And that's more important now than ever as we think about some of the challenges that are happening in the economy, and making sure that you're spreading that risk over multiple markets, multiple assets, so that you don't have all of your eggs in one basket. And then again, think about how you can continuously educate yourself and be in environments where you can promote a continuous learning experience, and be involved with companies that also promote learning and development. And then ultimately ask questions. So if you're interested in reaching out to us to have further conversations, again, this is a high level detail on private placements. There's a lot more information, resources, and intricacies involved with private placements. Feel free to reach out to me. You can see all of the links here and how to get in contact and my phone number as well. I will also in the chat put a link directly to my calendar. So feel free, and if you have any follow-up questions now, go ahead and schedule a call with me, and let's talk about your investment philosophy, and then figure out what additional things I can support with, and determining what is the right solution for you as an investor, and thinking about those opportunities that exist for private placements. So with that, we'll open it up to questions. I see that we do have one question here in the Q&A. I would encourage you, if you have other things that are on your mind that you would like to ask right now, go ahead and type them into the Q&A box and we'll get them addressed here. So the first question from Tim is, are you doing EB5 transactions? And Tim, I am not familiar with EB5 transactions. If you want to provide any additional context to that, and maybe that'll trigger. I'm assuming the answer is probably no, since I'm not familiar with EB5 transactions. And then next, Tim asked, how many commercial real estate properties are in your portfolio and what is the value of each? So currently we have a portfolio that spans across right now 8 different markets in the US and as well 2 different markets internationally. And with that, our total valuation for portfolio as a whole is right under $3 million. And so we've got also experience, we've got a portion of a resort property that we participate in, and then also some mixed use properties that are part of our portfolio as well. All right, I've got a question from Francisco. Excellent presentation, plain, simple, and clear. Thanks, Francisco, appreciate the feedback. And then Sherry, I'm new to syndication, so in addition to creating an LLC for each multifamily deal, sponsors must have a relationship with a company like yours. And Sherry may need to provide clarification on the question there. Are you looking to participate as a passive investor? Or are you looking to participate as or have your own active syndication business? I will try to answer that both ways. So if you are a passive investor, a LLC is not required. You do have the ability to participate as a LLC in a syndication deal. If you're doing an active syndication, yes, you would need to set that up, the proper legal structure. Again, that snapshot is kind of the basic with a management company and then the syndication that falls underneath it. But as a passive investor, it would not be required to have an LLC, but you definitely can participate that way in addition to a self-directed IRA account or directly with you yourself. And then Sabrina, looks like, I believe the EB5 refers to extents for a visa program. Okay, thank you, Sabrina. So we have not worked historically with any foreign investors. So that's where I don't have that experience in that realm, but definitely if that question is, still have that question, reach out to me and I will definitely put you in contact with some folks and our team, our legal team that can provide some more details. And more clarification, thanks Tim for that. So yeah, definitely reach out if you've got any additional questions on the EB5. We don't currently have any experience with foreign investors, but we can definitely put you in contact with the appropriate folks to help out with that. Eddie, what is your rent collection percentage currently, and what is your prediction in the next 3 months? Eddie, we've actually been very fortunate. So that's one of the things from a diverse portfolio that we're looking at. Is that it's been beneficial to have multiple different markets. So we were, for the month of April, we were at 100%. which is actually kind of unheard of, and we were surprised because typically we have a few different properties that may be delayed or delinquent on rent, but we actually hit 100%. For the month of May, we were a little bit lower. We were right at 97.5%. We're still seeing a positive trend. The great news is we've got a few different folks that have decided to, they can't pay everything up front, so they've put a payment plan in place, and so they're still making those payments in accordance with that payment plan, and do have 2 vacancies currently. I've got another one that popped up. Should I wait until I become an accredited investor if I feel the financial risk would be greater as a non-accredited investor? And what I would say to that is that it depends on your investment philosophy. So, one thing to take into consideration is what is your risk threshold and what are you willing to take on as far as that the risk is concerned. One thing that I would say is everybody has to start somewhere. And in order to get to that accreditation status, I definitely encourage you to look at investments that fit your philosophy and ensuring that you're able to continue to build that resume. But again, doing that with things that make sense for you personally. So that kind of all depends. Would love to talk and kind of have a greater discussion in your unique situation if you want to reach out as well. Rick asked, how many of your offerings lost money at the time of the exit? Have you suspended any distributions from current offerings, and how many of your offerings had capital calls? So right now, our philosophy is that we'd like long-term buy and hold. That's what we've done in our portfolio from a business perspective, and that's what we're also offering to our investors. So typically our exit strategy, if we have an exit strategy, is some type of refinance, and where we're pulling out that investor capital, and there may be an opportunity for the investor to continue to participate and get some return. So at this time, we have not lost any money from an exit, and we've also not suspended any distributions from current offerings. We are currently involved in an offering where, given the circumstances and the environment, we're not able to start development right now. But the great news on that is, with not having development taking place, we're also not incurring additional expenses associated with it. So ultimately, the money is basically sitting in an account, essentially, until we can flip that switch and it makes sense to do so. So it's actually, we had calls with our investors about a month ago and kind of told them, hey, this is what the situation is and what we're watching out for. And everybody was ecstatic that hey, we're not losing money. It's sitting there. We're waiting for that moment. So that's interesting. And to your question about any capital calls, we have not had any capital calls. And that's one of the things that we like to be very conservative in our approach, and making sure that we think about all of those factors that could go wrong potentially, and have those funds available. Eddie asks, what opportunities do you see coming in the next 12 months? That is a great question. And obviously it's a changing environment. One of the things that we're looking at currently is a reverse syndication that I mentioned, where investors would participate in the equity for the existing portfolio. And with that, I think those are a lot of things that you'll start seeing with other companies. We've had conversations with some of our peers, and they're looking at similar types of opportunities. Because what that does is that spreads the risk, and then also it making sure that you're set from a unique opportunity where you're able to continue to collect cash flow and not be in a situation where there's potential for litigation, and so that minimizes that risk there as well. And then in addition to that, I think there's a huge opportunity right now for agriculture. It's something that we have experience in, and something that we're watching and having discussions. And as we see a lot of the news and updates in the marketplace, that is going to be a big opportunity for companies to look at where agriculture can be part of that investment portfolio. Tim asked, can you send over the slide deck? And I can definitely send this over. If you reach out to me directly, I can send me an email and I'll get you a copy of the deck for your reference. And I know that this webinar is also being recorded. Sherry, thank you for the feedback there. Tim, do you have an asset list that can be shown to prospective investors? Yes, definitely. That's one thing we believe in transparency and making sure that we talk through what our portfolio looks like and kind of the details associated with it. So I'd be happy to share that. How many hotel projects, multifamily projects, manufacturing, office projects do we have? So we have right now the one hotel. We've got one multifamily that we're working on, and we have not dabbled in manufacturing, but we do have some people in our network, and that office relates to that mixed use that I referenced there as well. From Anonymous, for multifamily syndication or commercial syndication, what are your typical investment minimums for your syndication as a non-accredited investor? Typically, how long is this lockup period? So I would say that a lot of times the minimum is 50,000, and sometimes that threshold is set because, again, we can only take on 35 non-accredited investors in a project. So that period of time on average for any given project is usually at 5 to 7 years as far as the initial capital investment. Of course, cash flow occurs prior to that time. And then that's just depending on the project, what that exit strategy, if it's going to be a refinance or what those opportunities are with that. Greg, if one has a 1031, is this something that that investor could do? That is an excellent question. And yes, that is something that is an option for a 1031. You do need to work with your legal team and that sponsor associated with it, because there are some complexities. You have to be listed in the private placement. So definitely work with your legal team to get that set up and have those specific conversations with the sponsor. Rick asked, do investors have the ability to sell their interest to the sponsor before a formal exit? If so, how much of a hit would the investor take? So Rick, in short, the answer is it depends. And it depends on what that structure looks like and how it's called out in the PPM. But as an example, we have structured before where essentially if an investor needs to exit for any reason, and we say it's an emergency situation because you need to plan for the long term, then have that conversation with us and let's talk through it. And first, it would open up to the sponsors to be able to basically buy out the interest. Then it would open up to the existing investor pool, and then ultimately to the open market and any other investors that may be involved.
Ryan, anyone that has more questions, unfortunately, we do have to wrap it up, but you can always reach out to Ryan directly. If we can go back one page, this is his direct contact information. So feel free to reach out to him and his team. They'll be more than happy to talk to you one-on-one. And if you have any questions specifically about using self-directed IRAs, you can reach out to myself or Lisa or Jonathan on the sales team here at NewView. Ryan, thank you so much for that information. We definitely had some great questions and you did a great job. And I look forward to having you present for us again in the future.
Yeah, thanks, Brian. I appreciate the opportunity.
All right. Thanks, guys. Have a wonderful day.
Thank you.